Hi, I'm Ross Mayfield, Investment Strategy Analyst at Baird, and we are back for another weekly video with our friends at Strategas. Today, I'm thrilled to be joined by President and Head of Portfolio Strategy, Nicholas Bohnsack. Nick, how are you doing today?
I'm great. Thanks for having us.
Yeah, so let's jump right in. We're at a bit of an interesting moment in markets. You all put out a monthly sector allocation note, asset allocation note, and to sum it all up, you're sticking with the cyclical trade at a time when it's a little less in vogue than it was earlier in 2021. Could you talk to me about why that is?
Yeah, it is the question, I think, on a lot of investors' minds. The reality is that the recovery in the economy has been a little more jagged, perhaps than we thought, or perhaps investors in general had hoped. Clearly, some of the constraints around supply chain bottlenecks are real and pronounced, and others are more amorphous, like the emergence of the Delta variant. But I think for us, at the end of the day, to get away from the cyclical trade really requires one to build a firm case for why you would want to be counter-cyclical or defensive. And at this point in the recovery, that really seems premature. So it stands to reason, at least by our lights, that we want to perhaps take our lumps a little bit and look for opportunities as opposed to just throwing in the towel.
I think that's a great way to look at it. If you're not cyclical, you're counter-cyclical and defensive. And while there are some headwinds, you mentioned a few, there are clearly a bunch of tailwinds as well. And one of the biggest ones, and it has been since 2020, is policy. Monetary policy is easy, fiscal policy is huge. I do think people are concerned that as the policy accommodation goes away, it'll be hard to sustain the expansion. You all seem to land on a different front than that, but how are you all thinking about policy and how it plays into this cyclical expansion we're facing?
Yeah, listen, to take policy to encompass policy in total, both, which is to say both fiscal and monetary. There's no question that we've been aided in the recovery by the tailwinds provided by both the Congress and the central bank. There's no question about it. I think by our lights, we do see a very clear and marked improvement in activity in the economy. Maybe it wasn't as robust as people hoped it would be in the second quarter, but we've clearly seen an increase in demand. We've clearly seen an increase in output, and we've clearly seen an increase in revenue. So we're at a point in the recovery or the traditional recovery sequence where we would either see a big increase in investment, which is a telltale sign that an organic expansion will persist, or it's all just going to matriculate to profits, at which point the economy may run a little bit ahead of itself and a little, too fast and too hot, and policy is sort of there to help cool it. My own sense is that for all the political machinations, the checks and balances that we have, not just within the Congress and other parts of the government, but also inclusive of the central bank, will actually allow us to have almost a perfect policy prescription, so that some of those organic drivers can take hold. But it will really come down to whether corporate operators and consumers, each in their own way, have a confidence to go out and engage in traditional behaviors.
That's a great point. I mean, first and foremost, it's COVID-19 and the Delta variant, and then all of the other implications, kind of fall in the background. And the reality is the future is unknown on that front. And on that topic, I love this quote from a recent report that you all wrote that there's a tendency in pockets of uncertainty for investors to draw intermediate term conclusions from every piece of timely information to hit the tape. I think that's so true. I totally agree. It's human nature. So when facing uncertainty, like the uncertainty we're facing now, what are the indicators you are looking at? How do you cut through the noise? If you had to pick one item, what would it be?
Yeah, I believe that. I think it is human nature to sort of focus on what you have right in front of you when you're uncertain. So let me just sort of digest it into one sort of almost universal piece of data that we'll get. It won't be universally applied or digested, but it'll be universal all the same, is how schools reopen, right? If we have a circumstance that's very fragmented, where a lot of our students are not going back in person 5 days a week, it's more of a virtual application. I think we're in for some more jaggedness and unevenness as this business cycle gets itself underway. If we have more of a smooth reopening, which is to say more students back in the classroom, more days a week, that opens up a lot of labor. A lot of folks in the labor market who may be displaced may have been engaged in childcare, for their own children, who will be able to get back into the workforce. So I think if you just want to look at one thing, it's coming up. It's a couple weeks away in some parts of the country, a month in others, is how schools reopen.
That's fascinating. There's a billion market indicators out there, and this one is certainly outside of the box, but I think it makes a ton of sense the way you broke it down. Well, with that, we'll let you go. I really appreciate you being here with us today, Nick, and hopefully we'll chat with you soon.